Good afternoon, everyone. My name is Caleb Miller. I'm a marketing analyst at CryptoFi. And before we hand it over to our panel for discussion today on getting your bank or credit union ready for digital assets, we're just going to review a few housekeeping items. First off, you'll notice the bottom of your screen, there is a Q&A option if you are on desktop. If you have any questions about anything covered or not covered during this conversation, or anything else you'd like our panel to dive into, feel free to leave a question in there. And then at the end, maybe for the last 10 minutes or so, time permitting, we'll get to some of those questions. Secondly, shortly after this panel, you will be getting an email from the team at CryptoFi with a link to a recording of this webinar if you'd like to review anything, as well as a short survey just asking you how you think the event went and any suggestions you may have for future events with us. Lastly, we hope you enjoy this webinar, and without further ado, I'll pass it over to Cynthia Schroeder with Visions.
Great, thank you, Caleb, and welcome to all that have joined us. We are in for an interesting hour as we have three highly experienced leaders in the crypto and digital asset space, getting ready to share their thoughts on best practices in and with digital assets and the ecosystem and strategies for success. So I'm excited to introduce our panelists for today. We have Kian Sarreshteh, CEO from CryptoFi, John Ungerland, CIO from DaLand CUSO, and Patti Wubbels, the SVP of Client Development and Digital Assets Advisory Services with Strategic Resource Management. And I'm your moderator, Cynthia Schroeder, SVP of Digital Assets at Visions Federal Credit Union. And at Visions, we made digital assets, not just crypto, but the digital assets ecosystem a strategic focus due to several reasons. The behaviors of our members buying and selling from crypto exchanges increased tremendously in 2021. This concern with disruption these new technologies could cause if we didn't learn as much as we could about them and turn them into opportunities, and our decision to become an influencer across our industry as we begin to learn together the risks and the opportunities. So we've spent a great deal of time listening to our employees and our members and ongoing education. And our first entrance into this space was the buy, sell, hold opportunity, which we rolled out to our members in January of this year. What we found early in our digital asset journey is that there is so much more to digital assets and its opportunities for financial institutions. And there are new solution providers coming into this space every day and new opportunities to help us all grow our business, increase our member and customer financial wellness, and implement operational efficiencies. So before we hear more about these opportunities and much more from our panelists, we're going to start with a poll on how familiar our audience is with crypto and digital assets. So if you could take time to answer the poll, please.
Do we get an answer, or will that throw it off?
This is interesting that I can hold my own in a crypto conversation. When I've done these polls in the past, that's not normal. Normally what I see more that they're a newbie or familiar with the basics. All right, very interesting. Thank you for taking the time to do that. All right, well, we're going to jump into our first topic. So I'm going to start with a question, and we're going to start with Patti. This question is going to be towards Patti to start, and then John and Kian. So in your experiences, have you seen the shift in the past year from skepticism to urgency and interest surrounding cryptocurrency or digital assets in financial institutions, and how they can start their journey? So could you provide some examples of each, Patti?
Yeah, I mean, our poll right there, it's not something that I do when I start any of my speaking sessions, is ask. And I've done that for a while because I always want to know, where is it starting to tip the scale? So in the beginning, a lot of people that didn't know very much. Now we're starting to see those rooms split, and it's going to continue to go to the other side of that. So I think the skepticism, it's a learning curve, and we're in the middle of that curve. A lot of things are happening. People are starting to understand it. Even if you looked at the congressional hearings and the finance committee, they were skeptics at first, and now they're coming along and understanding where this technology is heading for us. So I think that because there's so many different technology, different use cases, different things that are happening, it's not linear where it's just the buy, sell, hold piece. It's not just cryptocurrency. People are starting to learn all these different ways that they might be able to incorporate into their to their financial institutions, for their customers, for their members, for themselves and their own financial institution.
Thank you. And John?
Yeah, I agree. The poll results from this gathering really speak for themselves, that we've reached a watershed moment, if you will, in the evolution of what it's going to look like to incorporate these digital assets into banking. Definitely that poll would have looked different even, I would argue, 45 days ago, 30 days ago. And I think it's really important to call out like that kind of specific time frame around how rapidly this division or this separation and shift is happening. In the crypto space, of course, we have the language, flip the switch. That's really the dynamics of what the switch to digital assets is going to look like as it goes mainstream. It's going to be a switch flip phenomenon, not on 1 month or 1 day, on the next. And that poll is really indicative of that to me. I think it's probably being driven by the fact that we're living through let's just stick with the last 45 days of news cycle that might drive a poll like that. We've seen things like the BlackRock announcement, the shift in these assets to becoming available to institutional banking investors. If institutional banking investors are, considering them an integral part of the portfolio, then naturally retail banking will follow, because that's where the institutional banks derive their investment, capital from. We've seen things that have taken place like Russia and BRICS nations use cryptocurrency and Bitcoin as or talk about using it as a parallel economy to work around sanctions and the dollar. And whether or not somebody has certain, ethical opinions about that, these conversations are evolving, and we're seeing, nation states and banking systems pivot to treating the asset as integral to their portfolio, and to treat it as capital that has to be taken seriously in the financial system. So yeah, much less skepticism, much more urgency, but still I think a lot of confusion and some risks that go with that confusion.
And Kian?
Yeah, I mean, I've been on this journey now, trying to introduce cryptocurrency to banks and credit unions for a little over 2 years, and thinking back to some of the early conversations. I guess there really wasn't that many early conversations because not many bankers wanted to talk to us about cryptocurrency back in 2020. And I think we've all seen how that's evolved over the last couple of years, all the institutional adoption that we've seen. And John, I think you made a great point that, once the institutions start to adopt crypto, it's going to trickle down into retail, which is one of the primary use cases right now that, Cynthia, I know your credit union's doing, and we're talking to a lot of other credit unions and banks around doing the same thing from a retail standpoint. So, from an urgency standpoint, I don't necessarily know if we're quite yet there, where these banks and credit unions are rushing to adopt crypto. I think everyone's, more has the mindset of having an urgency to understand and, start to get a roadmap together around what an initial solution could look like. And, John, you mentioned some of the confusion as well. And I think a lot of the confusion really sits just within, where do I start and what are the use cases that are going to add value to my financial institution, right? And so I think the easiest one to understand out of the box, and what there are a lot of out of the box solutions out there right now, are on that retail buy, sell, hold use case, which I know, Cynthia, you've started with, and I'm sure you all are thinking about other use cases that you can layer on top of that. But to me, if you're an FI and you are just starting to explore cryptocurrency, exploring the retail buy, sell, hold likely makes the most sense. And starting by just looking at your data and seeing how much capital is flowing out to the popular exchanges that are out there today. And that's, a lot of where our conversations start with FIs that we work with is helping them understand, how much capital is flowing to Coinbase and how much is going to FTX and how much is going to crypto.com. And we start to add all of those up, it becomes a material number that should at least prompt a discussion and hopefully some action around being able to implement a crypto solution that would compete with these third-party exchanges, because the third-party exchanges, and not just exchanges, but other apps that offer crypto as well, like Robinhood and PayPal now and Venmo and everyone, right? And so there's this secular trend that we've really seen, and I think Robinhood really started this back in 2020 when they turned on a checking account product and a debit card, and now we see even SoFi offering crypto, right? So when one of your credit union members or banking customers transfers their fiat over to the SoFi to buy crypto, they're likely to get their loan there too, right? And so there's this trend of these FIs now, these fintechs now wanting to be one-stop shops for both crypto and banking. And if you're a credit union or a bank and you're trying to remain competitive, which I know everyone is, crypto is a great first step to be able to take advantage of an opportunity to recapture a lot of that capital and recapture a lot of your user base that might have been leaving to go to these third-party fintechs. So that's what I would say to that.
Yeah, our VP of digital assets and myself, Joe Keller, and myself have had calls, probably 2-3 calls a week over the last probably 3 or 4 months with credit unions that are just now trying to find a way to get started in this. So it's definitely increased over the last probably 3 or 4 months that the interest is growing. All right, anything else on that topic, Patti or John?
No, I agree.
Oh, sorry, Patti, go ahead.
I was just going to say the same thing. I mean, our SRM has been helping from a consultancy standpoint with that education piece first and foremost, and we're just getting more and more requests for not only for the board and strategic planning for executive team, but now we're starting to get requests to come in and talk to our operations team, come in and talk to our compliance and risk team. And they're starting to, our lending team, and starting to really understand from all aspects of it. Sorry, John, go ahead.
Completely agree with that on the demand for the educational seminars and what I would call executive strategy consulting. So this has been our busiest year ever talking about this topic with FI clients and community FIs. I do believe there is a sense of urgency. So, Kian questioned the urgency. I think it's okay for us to disagree here and have a consensus, even in disagreement. I think there is a sense of urgency around getting educated and putting together a strategy. And I do mean a long-term strategy, like a 24, 36-month strategy to deal with this space. I kind of confined my earlier comments to 45 days or so of news cycle, which involved geopolitics and investment banks and BlackRock, and which is only $10 trillion in assets. So that's not a big deal. But if we go back to June, all the way in the Wayback Machine to June, that was when Bank of America did their now infamous survey. And in that survey of the 1,100 people they surveyed or whatever, and more than half of them said they intended to buy digital assets in the next 6 months. Well, now we're right in the middle of that next 6 months. So that and many other indicators around technical fundamentals for different cryptocurrency networks and markets and stuff indicate that we seem to be squarely in the prime time for a huge uptick in adoption. And these are very sticky products. If this money leaves your institution, fighting to get it back is going to be a much more expensive endeavor than doing something strategically to preserve it. So I feel a little bit different about the urgency there.
Good point.
All right. Thank you all. We're going to move to topic number 2. So the question is, what are the risks and opportunities that you have all become aware of with this renewed hype in crypto or digital assets? We're going to start with John on this one.
Yeah, I think it's appropriate to call it a renewed hype because we went through a cycle in 2017 to 2019 with huge upticks, and then we saw a huge boom in the Bitcoin to dollar valuation market cap last year. And then of course, since last December, we've just been hammered down as analysts in this space with all the FUD, or the fear, uncertainty, and doubt coming from mainstream institutionalists. But there does seem to be a resurgence recently, I think motivated by, again, like the president's working group study on the piece, the probability that we're going to get legislation around it in the first quarter next year, European Union crafting its final language. And with all of that, I think there are risks that the community banking, the local financial services space, the retail space is going to rush into solutions as duct tape and baling wire stopgap solutions. Like there's always people make a lot of money in the banking technology and IT space selling platforms as solutions. Mm-hmm. And I definitely think this is going to be the next space where there's a huge craze for buying something to solve a problem of being a little bit behind the curve. The risk in that is, I think, if you don't walk through the process of designing a strategy, building operations, looking at what these networks represent beyond just what the value of a Bitcoin is, there's a huge risk that in the next 6 months to a year, you could disintermediate yourself from your own business. You could, as a money storer and mover, you could cut yourself out of the money storage and movement business by thinking that you can solve this problem just by buying a vendor or just by procuring some piece of technology. These networks and the money storage and movement and value storage and movement and transactional evolution that happens on them is way more revolutionary than just allowing us to pick vendors and update our operations. It's going to be more involved in that and require a better investment and strategy than that if we don't want to accidentally cut ourselves out of the money business as money institutions. So that's where I see risks specifically being a financial institution in this metamorphosis is going to come with a lot heavier burden to bear to do it right and not sacrifice your future.
Thank you. Kian.
Yeah, I think what's exciting for I think all of us here is that the renewed hype this time around. I guess when I think about the previous hype, I think back to 2018 when there was the big ICO boom, which I think was really bad for the general crypto population. It really cast a bad light on cryptocurrency and was not really what cryptocurrency was intended to be, right? And you look at today, the renewed hype, I think, is more from an institutional standpoint, and that's I think some of what you touched on there, John. And we've seen a lot of the recent news and BNY coming out and saying that they're offering custody services now is, I think, a big tailwind for crypto and the banking industry. And then, yesterday we see MasterCard making their big announcement that they have intentions now to offer crypto services into banks. And so, I mean, the hype now is, at the scale where it's not going anywhere. And I think it really triggers the actions of, how do I go about making sure I don't fall behind and have my business, really devoured by a third-party fintech or a larger bank that's going to be faster in rolling out a crypto solution. But the risks come with exactly what John was saying. If you just rush into a crypto solution just so you can say, me too, I'm doing crypto as well, you're going to set yourself up for some challenges. And there's a lot of different crypto vendors out there now that are catering to banks, which wasn't the case, in credit unions, obviously, which wasn't the case, a couple of years ago. And they all come with various value props and as well as various risks. Being able to understand the different components that go into a crypto program, I think, is really essential, which goes back to the education. So educating yourself, not just on what crypto is or what Bitcoin is, but how do I put the pieces together to build out an elegant solution that's going to add value to my credit union members or banking customers, and ultimately not set my financial institution up for failure or for increased challenges in the future if I don't do it right out of the gate. So, I would definitely encourage everyone to do your research and talk to multiple vendors out there so you can understand the different value adds that they might have or the different opportunities that you could take advantage of with them as they're on the roadmap. And I think, Cynthia, we'd love to hear your take on this actually, because you were definitely a trailblazer in getting the retail buy, sell, hold solution implemented. And, now you're probably thinking down the line on your roadmap. And, that's what we try and help our potential clients or current clients understand as well is, once you roll out let's say you start with buy, sell, hold, what comes next? There's a lot of exciting use cases that are out there. One that CryptoFi is working on right now that we're really excited about is deposits, allowing users to be able to natively access funds from a third-party exchange, as just Coinbase, and then natively deposit those into the custodial wallet from their bank or their credit union. On top of that, there's rewards, there's payments, there's a lot that can be done to add value to the users. And as we see this shift of moving from traditional finance into Web3, all of these things are going to be coming to fruition. And really the whole financial ecosystem, I think, is going to be evolving, and making sure you select the right vendor or the right solution from the get-go, not just to remain competitive in the next 6 to 12 months, but like John was saying, what's going to happen 24 to 36 months down the road, because there's so many different use cases and different ways that you can take advantage of crypto. And a lot of that, I think, is going to be a function of what the demographics of your user base looks like, right? And so educating yourself, doing your research, understanding who you're trying to cater to, I think are all important considerations before you actually dive into crypto. But I think we're seeing that now. I mean, that's where the conversations are focused around. So curious go ahead, Cynthia. Sorry.
I completely agree with you. I mean, we took the time to lay down on paper all these different initiatives within that digital asset ecosystem and prioritize them based on growth and complexity and all those different things. And we came out with our roadmap. But that's changed since we did that. We did that at the beginning of the year, and things have changed over the year. And we were interested in rewards, like you mentioned. We were interested in wallet for non-monetary and monetary. We're just looking at all of them and really digging into all these new vendors that are coming out with opportunities that we see, not only on the digital asset crypto side, but also on the underlying technology side, the blockchain side, the smart contracts, NFTs, all those different things. So interesting space. Patti.
Yeah, so I definitely want to say that there's risk of going at it alone for all of the reasons that you guys just talked about. I mean, there's just, even for us, we all have a hard time keeping up with all of this, much less somebody that's just going to try to do this on their own. So the risk of going alone, the risk of thinking you need to do all of these things, like you said, Cynthia, let's talk about the different use cases. What do we want to start with? And then start building out and planning for that from there. There's right now, when you think about the integrations and your tech stack, you have to think about, start questioning, and SRM's been in the market for 30 years with those vendor partnerships, and the vendor partnerships you have with your core providers and your online banking providers, which could be 5, 7, 10-year contracts. You need to be asking them, what are they doing in this space? Because if something's tying you to what your core on your online banking, and you've got to be able to shift and pivot as this starts to evolve, that's going to be an important consideration and a risk there as well. So having good due diligence, having the flexibility to pivot and explore different areas, those I think are all risks. The risk of not doing anything at all is an important risk for sure. Even if you're not planning on rolling anything out, you've got to be educating on this and seeing what the potential threat is to your base. But then on the other side, the opportunities, I think what we're really seeing in terms of opportunities is that it's impacting multiple business lines. So when you're putting a team together internally, you got to pull people from different areas so you get different perspectives and different aspects of what could be done in your shop.
Yeah, I completely agree too on that. And one of the things I heard this week or last week is that we've been doing a lot of training and education for our board and for our senior teams. But as you said earlier, Patti, it's as important to do the same type of training for your technical side too, because as these other things with smart contracts and blockchain and all those, that technical area needs to be well aware of what's happening in this space also. Really good points. What about from a regulatory stance? Any input on that?
Yeah, I also saw a question come through from Leo asking about the legal and insurance, which I think also plays into what you're asking now, Cynthia, around regulatory. So let me just address Leo's question and the regulatory space in general. So, I think the thing we're really encouraged about on the credit union side is that the NCUA is very supportive of cryptocurrency and innovation with blockchain technology in general, which I think contradicts a little bit of what's going on the banking side. If anyone follows the regulatory news of what's happening, what the OCC is saying right now about cryptocurrency, and the FDIC is requiring approval for cryptocurrency programs before they're rolled out by banks. There's I think a big opportunity right now for the credit union folks that are on this call to be a first mover and beat a lot of the banks to the punch, because what we're seeing right now is banks being stifled really by regulations, where credit unions have much more of an opportunity and are being supported by the NCUA to be able to take advantage of some of these use cases that we're talking about. So, from a legal standpoint, from a credit union at least, there's a few specific things that you got to be aware of. It's number one, how is the digital assets being custodied? That's, I think, really the starting point. And I know, John, I'm sure you have a lot of thoughts on that. And we at CryptoFi, we integrate with various digital asset qualified custodians, where a credit union would not have to bring that custody in-house. And as such, the digital assets being stored with a third party don't hit your balance sheet as well. So if the digital assets are being held by a third party custodian, the next thing that you have to ask is, how are those orders being filled? And this is just talking about the buy, sell, hold use case, right? And so a lot of the digital asset custodians now have integrated liquidity options where they actually will provide more competitive exchange rates than what a lot of the retail users are getting from the popular exchanges today. At CryptoFi, we're able to benchmark that, and through our custodial and liquidity networks, our exchange rates are about 40 basis points more competitive when we're compared side by side to Coinbase and Robinhood and most of our competitors that are out there, which we're encouraged by. So once you have your custody and your liquidity solution in place, those parties are the ones that are actually engaging with your credit union members, just to address your question, Leo. And so as such, the credit union is really just responsible for settling the aggregate trades on behalf of your members. So, in the digital banking experience, the credit unions, or at least if you work with CryptoFi, we give you the choice to either co-brand or white label. So, there's a couple considerations in there as well. If you want your credit union members to feel like they're engaging with your credit union directly, white labeling makes a lot of sense. But if you don't want to be blamed, for example, if the price of crypto drops, it may make more sense to have your crypto vendor co-brand and have their brand be the one that's blamed for any price changes within crypto. So when the members go to buy cryptocurrency for the first time, they have to accept terms and conditions, and regardless if it's co-branded or white labeled, they're essentially agreeing that the custodian and the source of liquidity is a separate company from the credit union, and the credit union is not actually involved in the transaction. So the counterparty, if you work with CryptoFi, would be the custodian, and then the technology provider would be CryptoFi. And a lot of the custodians have a lot of different stances on insurance, and I want to pass this over to John next, because that's his business here. But the ones that we're partnered with, and we hope to be partnered with DaLand CUSO here very soon as well. But the ones we're working with have various insurance offerings on the digital assets. So if anything were to happen to your members of cryptocurrency, in most cases at least, it would be insured. So the way that we bring this to market is safer for your credit union members or banking customers than what they would otherwise be getting on a third party today. So, just zooming out just real quick before I pass it over to you, John, from the macro standpoint, again, you look at the news cycles that have happened in the last, I don't know how long it's been now since Celsius had their issue of going bankrupt. But if your credit union members were holding their cryptocurrency on Celsius, you were essentially doing them a disservice by not allowing them a safer solution to buy, sell, and hold cryptocurrency natively through your digital banking environment, right? And so it's not just Celsius, though. There's a lot of other crypto platforms out there that don't have the user's best interest in mind, and there's ultimately going to be a lot of fallout from that. And it's a great opportunity for traditional FIs, credit unions and banks to be able to offer a safer place for your users to transact and hold and custody digital assets.
I don't fundamentally disagree with anything that you said there. I think we're at the early stages. I mean, well, there was research that came out recently about the rate of crypto adoption and user growth globally. And the researchers overlaid the early days of internet adoption with the early days of crypto adoption. And it's essentially a perfect replica of the adoption rates with maybe a slight uptick in crypto adoption recently. We're like in 1996 or 1998. So I provide that as context for two reasons. If you think about being in the 1998 days of internet adoption and how that was going to be commercialized and everything, and we apply that to this idea of all the volatility and instability and risk and getting blamed and all that, we have to remember that there was a point in time when the post office was talking about taxing every email that was sent through the internet as a way to regulatorily control the internet, the evolution and adoption of that. We look back on that now and that's silly, but I think we're living through those kinds of growth pains right now in this space with regulations where people are going to propose all kinds of absurd ideas to control this emerging market space, not least of which because their legacy banking models are slower, more expensive, riskier, less efficient, less secure than these new networks. So just like it's much more efficient to send an email. So I don't know that I agree. I don't agree with the fundamentals of anything you just said, Kian, but I don't know that I would characterize the NCUA as, I guess, welcoming or anything to the crypto space, or favorable, I think was the word you used. I would characterize them as ambivalent. I think the NCUA is ambivalent towards crypto right now. I think when we talk about what needs to happen with regulation and law in the crypto space for crypto banking, we do need institutions like the NCUA and others to come out and openly state that custodianship and control of this data is not only permissible, but encouraged for the reasons that you just stated. Because a local financial institution that is member owned and member governed is a better way to protect their wealth, be it digital or electronic dollar or physical or whatever, than gambling it on big tech companies in the cloud of the internet, as we saw with Celsius. So I do think that the NCUA is less restrictive than the banking side of things, but I think that they need to be more aggressive in clarifying the importance of protecting these digital assets for these local communities that these institutions serve. And only these institutions listening can go advocate for that. Another huge risk I see with regulation is that we seem to be living through this very, like I said, we're in 1998. So we're in the early stages of decentralization, the era of decentralization. And along with that is what I see as a growing sentiment of anti-institutionalism, right? So people are becoming suspect of big tech providers. They're becoming suspect of mega banks. They're losing faith in the Fed to get the dollar under control. It's all great. And that does represent huge potential for local FIs. But it also represents what I would call dollar instability and volatility. So we're likely to see some regulatory actions in the near future here that are like draconian or aggressive or crazy, maybe just like tack the idea, or at least talking about it, politicking on it, stumping on it. We're likely to see something like someone proposing the equivalent of taxing emails and text messages. And this corresponds to the risk question in the last segment. Like, we have to look at this as a long-term evolution of money merging with the internet. And we can't react to these regulatory news and dispositions right now. We should expect crazy things to come out from politicians as power changes hands, but we need to keep monitoring whether or not individuals and communities are using these new banking networks to store wealth. And if they are, then we need to make sure we're plugged into helping them store wealth and stewarding wealth cooperatively and communally. It's our institutional purpose. So that's why I have strong opinions about owning the data, controlling the data, advocating for the ability to do that, building operations to handle that, kicking your core providers in the butt, like Patti said, to do that, because otherwise you end up not being in the money business a few years from now. So.
Patti?
Yeah, I mean, again, when you get a panel like this, we all tend to say a couple of things, but maybe just a different way. And it's really easy to look back on things. Like if anyone has kids, you look back on their childhood and you're like, that was, pretty easy. And I see what we did right and did wrong, and I get it now. And it's harder when you're living in the middle of it, though. And so, to John's point, it's easy to look back on the internet and go, look at that, remember when it was dial up and it took 3 days to upload a picture, and there was these regulations and all these different iterations of intranets and stuff, and look at that back there and look at where we're at now. And now we're living in the middle of this evolutionary process, this creative destruction, until it becomes a paradigm shift. And you look back in history of huge paradigm shifts, and I'm sure in the middle of the horse and buggy versus car, or electricity and gas, there are huge things where you've got people that are not going to believe it, or don't feel it, or just can't get their head around it. And then all of a sudden there's no more horse and buggies. And they look back and they go, okay, we drive cars now. We have self-driving cars now. We don't even question these things. I don't know how to explain 5G, but I use my cell phone all the time. So I don't, I don't know how the internet works, but I have no problem using it right now. There's still bad guys on the internet. There's still things that, we're working out, but it's really, I think that's the most challenging thing, is we are literally living in it and changing every day. And it's hard when you're in the middle of that. It's easy to look back on it.
Great conversation. Really good conversation. All right. We are going to move to our next poll. So we're moving to poll number 2. Are you tracking, or do you have insight into your users' crypto activity? So if you could all answer the poll there. Oh, good.
It's such a great question, because you can't argue with what your customer or member base is doing. All of us could talk about how people are doing crypto and the usage is going up, but until you look at your own data and then see it, that's when it's really impactful, I think.
Now, I think the behaviors of our members with the crypto exchanges is something that we all should be, or members and customers should all be aware of. Tracking the inflows and the outflows. We started doing that in 2018. And then in 2021, it just went straight up. And that's when we decided it was time to really start our education and awareness around this space. So really very important. All right, so we've got a mixture here. No, but there's something we should look into. We know the basics, but haven't conducted a full inquiry. And no, and I don't see why it would be necessary. I guess the reason it'd be necessary is just so you do understand those behaviors of your members and your customers and know what they are doing with those crypto exchanges. I think that's, to me, that's very important. There is
a data point. I was just sorry, Cynthia, just from a data point, we know that for every $1 billion in assets, $1 million has been going out to the exchanges per month. If your institution is okay with that, defending your deposits or what you can lend against, we've been deposit heavy for a while because of the pandemic. We're not deposit, that's starting to be challenged now. So, and maybe it's low right now, but you have to look at it. There's caveats to it, only if they're using you as the source of funds, depending on what exchanges you're looking at, but at least it gives you a data set to start with. And then you just keep watching it. And when it gets to the point where your team decides, holy cow, we've got too much getting out of here, hopefully it's not too late, but you can see that there's money leaving your institution going out to these other places. Nobody can argue with that. And so I don't know why you wouldn't want to look at that data, but you've got it in your systems and be able to pull those reports.
And I wanted to share that there is a source, a free tool, a free secure tool that's offered by the Best Innovation Group. It's called CU Crypto Report. And they actually, it's 3 steps. They help you with create your folder or file. Caleb just posted the link there. They help you create your file, you upload your file, they produce a report back for you in a Power BI type format. Really great service. And then they can compare it if you want to see it compared to other institutions that have also submitted their data. They can share that with you too. So I wanted to share that with the group.
Good resource.
All righty. All right, we are going to move on to topic number 3. So we're going to start with Kian for this one. Participants might be aware of FedNow and real-time payments, SWIFT, and ISO 20022. How do these topics relate to this world of crypto and digital assets, or do they at all?
Well, yeah, they absolutely do. I mean, there's been a lot of news out around, what these sorts of services are starting to try and do in the world of crypto. I think we saw, Swift announce like their intentions to be able to, be a settlement network for digital assets as well, for payments to move that way. So, I think we started this panel by talking about the different use cases in crypto, and I think predominantly we've been talking more about the retail use cases. But when you start to think about the actual technology that underlies crypto, blockchain in itself is a much more efficient way of going about doing payments, especially if we're talking about cross-border payments. And I'm sure not every financial institution has that on their radar right now, but if you start to look at how you can go about optimizing and remaining competitive, and how you're engaging with the overall just financial ecosystem, 2, 3, 4 years down the road, these sorts of things are going to become, I think, more mainstream, just a matter of when. I think we started by seeing the shift of institutional adoption on the retail side first, and we're starting to see more of these, what we consider to be like these corporate use cases around, payments from bank to bank or institution to institution come into focus a lot more recently. And so I think, it took probably about 2 years for the retail use cases from when they were, I think, initially introduced until now to become more of a popular topic, which is, I think, telling by that first poll question that we saw, where most people on this call, I think, are familiar now with crypto. And that's, I think, by and large, because of the education that's been driven, about the activity that's been driven on the retail side. But I think same momentum we'll see, in my opinion, at least, go down the same, roadmap or timeline as we sort of saw the retail side go. So we, I think, have seen more recently this year, more announcements around all of those different, services that you mentioned. And I think we're going to see a lot more momentum around those come into focus in the next, 6 to 12 months. And that's one of the things at CryptoFi that we're also diving into. We're partnering with Finastras through FFDC and GPP, and working on some of those use cases around, how can financial institutions move money more efficiently, and blockchain technology is really underlying all of that. So that may be a little slower moving because there's a lot of regulations that are coming around that as well, but going to be a very interesting space that evolves over the next couple of years.
Patti.
I think that we just don't know what people are doing. I think there's a lot of technology that's being built and created behind the scenes. I mean, even Jamie Dimon publicly denounces it, but he's got JP Morgan Onyx, and that's a whole division that's building out their blockchain. So I would argue that retail is Main Street focused. We see those headlines. We see a lot of that. I don't think we see a lot of what's happening in that blockchain space. I would say that FedNow, real-time payments, just actually what Kian said, they're incorporating that. It's almost like an extension of the president's working group order that said, figure out what all the friction points are and see if this technology can make things better in some way or shape or form. And so they're hopefully looking at that and saying, hey, before we launch this, let's take a beat and see if we can incorporate that. And I think we're seeing a lot of that too. And then I was going to say too, something that you had said, when institutions are now, at least the ones that we've talked to, looking at that type of technology, when you start to think that you can reduce overhead costs, or you can reduce the amount of money your financial institution pays for reducing fraud and all of the things that happen in those particular areas, that becomes something of a conversation that an institution wants to say, wait a minute, we can reduce these operational costs. We can reduce, there's a lot of things that they start to get their head around that. Why wouldn't we want to do that? And my two examples that I had recently was there was a 4% interest rate, a savings account that somebody's offering right now. And the reason that they're doing it is they're offering it off of the blockchain. So that institution has reduced their overhead costs enough that they can now offer a higher interest rate. I'll take a 4% APYs, and that's not even cryptocurrency. That's just distributed ledger technology. I'll take that all day long, and you've got your Main Street customers or members that hear about that. They're going to flock to that. Is that something that might be what your institution would want to offer? At the same time, I had another institution where I opened an account, and it's been a week and I'm still trying to get that account to be open. Those are friction points. Looking for those friction points and finding out, how can we make this a better process for our members' experience, our customers' experience, and our own internal mid and back office efficiencies that are really impactful?
Great points. John.
Yeah, so the question was about ISO 222 and FedNow, or real-time Fed, but it was asked after this survey question where a lot of people said, why would we be measuring crypto? And actually these two go together. So, you should be measuring whether or not you have deposits leaving your institution or people engaging with crypto, because the Fed is talking about ISO 222. And the Fed, by the way, is measuring systematically, globally, literally globally, how much money is leaving the banking system and not coming back in. As a retail bank or a local institution, you're just a participant in that electronic dollar structure of the centralized banking system. So if the central bankers are measuring how much capital is leaving the system, which they are, you can go back and look in their Q2 and Q1 reports from earlier this year, and they have actual flow diagrams that show where the money leaves the banking system when it goes to crypto, and that it only comes back in under certain conditions. We should all be aware of that because we're subject to the same dynamics impacting their larger system. That's the answer to the survey. ISO 222 and FedNow, we should also be paying attention to your question. We should be paying attention to these flows and relationships that we have, because the Fed is talking about ISO 222 and FedNow as a crypto killer. Okay, that's their open public discourse language for this stuff. So they're hoping that by using the distributed ledger technology and blockchain technology, they'll be able to they'll keep the electronic dollar on life support essentially, and make it faster, better, cheaper to transport and use and store. And they're really going, that's one half of their bet, and their ability to implement those protocols, they're betting will keep institutional and individual capital from flowing into crypto. That's the stakes. That's how they're looking at it. And that's why every FI should look at it that way. The Fed is exploring these DLT-based technologies as a way to keep people from moving into crypto. So what does that mean? That means that the people who run the central banks and set monetary policy and create electronic dollars are well aware of a world where we might have parallel economies of private digital assets and public, digital dollars or whatever. I like to call it central banker, dumb currencies, CBDCs versus private digital assets. But that seems to be the landscape that we're heading toward. And as we see more and more news about ISO 222 and real-time SWIFT and FedNow and how they're going to kill crypto, this connects all the way back to the prior discussion about risks and regulation. We have to be careful as folks charting strategy and building solutions for FIs, not to get duped into putting everything in the basket of keeping electronic dollars alive. And that's what these technologies you mentioned do. ISO 222, SWIFT, FedNow, they're about keeping the electronic dollar alive. We don't seem to see any data in the marketplace that says our consumers inherently want us to keep electronic dollars alive. They seem to be looking for better value return and safer, more stable storage, to Patti's point. And that data is clear. I'll close with this comment. You must, as an existential imperative, monitor your capital outflows from crypto. And here's why. In that Fed report that I alluded to a minute ago, or referenced a minute ago, they identify in that data that in 2018, prior to the last huge crypto bull cycle, where $1 trillion flooded in, literally $1 trillion flooded in. There were about $50 million. There was $5 million in stable coins in the crypto market. There are now 30 times that amount of market cap in stable coins living outside of FIs. So if you just correlate a 30x increase in crypto market cap due to all that dry powder sitting on the sidelines, you are going to have members and communities and institutions and corporations add this stuff to their balance sheet and move into it as a way to generate a return in a world of fundamental dollar instabilities. And we're likely all going to confront a challenge of having to believe whether ISO 222 and Fed now will be our redemption as institutions. And in order to believe that, we're going to have to trust the same people that said inflation is transitory. So keep that in mind and maybe build strategies that don't rely on only their uses of these technologies.
Coinmarketcap.com. If you don't know how much money is flowing through the daily trading volume of stable coins or any of the other cryptocurrencies, it's a great visual just to see real-time money movement through that cryptocurrency. And those are all money that left financial institutions at some point.
Great information. Great information. Thanks for that conversation. We're going to move to our final poll now. We already have a crypto strategy rolling, but would like help with marketing and operations. Oh, maybe I've got the wrong one. Oh, okay. Yep, got the wrong one there. How far is your institution into implementing a crypto strategy? So if you all could answer this one for us. So it looks like we've just started looking recently, but are looking for, I can't read that all the way. For support. Well, that's a good one. And then we've built out our strategy, some of our strategy. So I think that's a good answer there about support. So Patti or John or Kian, what type of support suggestions or ideas can you share with the audience on how they can get started with a crypto strategy or just overall awareness? And we've shared some, but is there anything else to share?
I mean, ever since SRM started with our crypto advisory or digital asset advisory team, it's really evolved into the 4 buckets. And the first one is that needs assessment, looking at those outflows, inflows and outflows, getting that education, getting the different teams, facilitating conversations, and starting to think about it and really open your eyes to not just my competition as banks and credit unions, but with Robinhood and you know, any neobank or fintech. You have to really start to expand who you're competing with now. And then as you all start to learn more, then you start to build out these use cases. What feels good for our institution, our customers, internally, retail side, explore all these different, you may come up with a new idea for offering something. And then finding out who the right partner is to partner up with it, which is what we've talked about already, making sure that your vendor isn't driving your strategy, that you've come up with your strategy and you find the right vendor to take you on that journey, and then decide, is this a short term? Are we in this for the long term? Can we pivot if and when we need to? So it's a lot of strategy conversations. And then how are we going to roll it out? The disclosures are going to be super important, which was part of an earlier question. Disclosures, working with the regulators. I think part of the reason, you know, John, that some of these regulators aren't saying more is because they don't know what to say. So we need our financial institutions to be pushing this information up to them so they can speak out and say, this is what we need. This is what we're seeing. And that might be helpful in that particular area. So that's what I'd say on that.
Thank you.
Yeah, I would just add what Patti said. I mean, you know, talking to as many people in this industry, when I say industry, I mean crypto and banking, which is a subset of crypto. I think there's an overwhelming amount of education that's available about there on crypto and blockchain in general. But, you know, crypto and banking is very new. And if you're going to be exploring the retail use case, which seems to be the popular place to start, I think asking, you know, someone like SRM is a great idea to start, or asking who your digital banking provider works with from a crypto perspective. And then whoever those vendors are, talk to all of them and understand, what their thesis is and what their differentiators and unique value props are, so you can start to understand, the impact that crypto could have on your financial institution.
And not be afraid to find one of these other emerging technologies. If CryptoFi hasn't talked to a certain vendor that your shop is working with yet, that's an introduction. That's an integration that they may not be aware of yet, but you're driving that partnership. So not be afraid of whoever your core, your online banking is already working with. There are other emerging options out there too that might be, just to give you comparisons. It's just like if I do AT&T or Verizon, I'm going to look at them both and weigh my pros and cons and see which one works better for me.
John?
Yeah, again, I agree with all or most or all of that. I have like one kind of silly comment and then one story that I'll close with. So my silly comment would be, there's these old clips circulating around. I made the comparison to the adoption of the internet and us being like circa 96, 98. And there are really funny videos you can go look up on YouTube out there of like the Good Morning America crew talking to somebody about the internet, and people being like, oh, that's like weird. Why would anybody want to use that? Or that seems like silly. It seems like a lot of effort to sit down at a computer and type something into it. And so I honestly think that one of the best, I think that's an important in framing of the evolution that's taking place, is that if you want to go get actual information about what's happening with crypto, you're going to have to go to places that seem weird and feel uncomfortable. You're going to have to do a lot. I mean, you should need to set up an alert for hashtag Bitcoin, hashtag Bitcoin US dollar, hashtag crypto, hashtag crypto banking, and monitor that stuff. And you're going to have to wade through a bunch of crypto boys and crypto gals, as they're known, out there saying crazy things about how they're going to get Lamborghinis in the next 6 months. And for every 10 of those you read, you're going to see a story where somebody is actually connecting the dots in a very prescient way of how money is going to merge with the internet. And there will no longer be a bank account that lives outside the internet. And there will no longer be spending money on the internet, because your money will be part of the internet. And those people are out there, and you can read what they say on Twitter, you can read what they say on LinkedIn, and you should stay apprised of what the lunatics are saying, because the lunatics are building the Apples and Amazons and Googles of the next 15 years. And so, it's an entertaining part of my job that I get to watch what these people are saying and share it with the financial institutions. And that's what we're committed to doing. The less silly part of what I'll say is that when we talk about what's coming next and how to get started, we have to realize that we're in a very transitional state and a very nascent state. And so we can build plans and we can buy vendors and we can pursue bolt-ons and we can shop around. But we also have to realize that we're probably dealing with like such a major paradigm shift that the way we've done things the last 30 years, picking technology, just isn't going to apply to this paradigm. We're going to have to ask more fundamental questions about what it means to stay in the money business, what it means to be a value storer and a value transactor. We're going to have to look at really difficult conversations where CFOs and other people might pound the table and say, you're a heretic for believing that the dollar is going to be fundamentally challenged. And yet, that's likely to be what's going to happen, right? We're going to see the Postmaster General get pissed off that you're not going to have to send a letter all the time to communicate anymore. And we can't let that block strategy and innovation formation. So that's kind of the mindset we bring to it, is you can't assume the base operation, the legacy configuration, the methodologies of the last 30 years for picking technology to be the thing that's going to work for this space. It's got to be a longer term strategy that recognizes the fluidity of it, embraces the dynamism of it, gets real comfortable with the weirdness of it all, and is just committed to one thing: being a stable local storehouse of value for the institutions and individuals in your community. Otherwise, the Apples and Amazons and Googles of money that are going to rise up around us will gladly take over that data from you and dispossess you of that relationship in a few years' time.
Yep. Well, we are almost out of time. I really appreciate your time, Patti, Kian, and John. I appreciate the audience joining us today. There are a lot of resources out there. If you are interested in getting started, you can reach out to me, reach out to any of us. I have a list of resources of speakers, of working groups that you could join, different things. So I think that's a wrap. Anything left, Patti or John or Kian? Anything else? No.
Just thrilled that there were a lot of people here learning about this, because it's good, urgent, necessary, and noble. So thank you for coordinating it and moderating it, Cynthia.
Well, I loved the conversation. It's always good to have a group of people sit around and talk about it and have different perspectives on it. So I appreciate being here.
Great.
Absolutely.
Thank you all.
Cynthia.
All right.
Good
Have a
chat with
great
you,
night.
John. Yep.
Bye.
Thanks.
Bye-bye.